Somewhere on your For You page right now, someone is telling you they found an infinite money glitch, or that you can buy 10 houses with no money down. Today we're breaking down the worst financial advice going viral on TikTok and what actually happens if you try it. When I say toxic financial advice, I mean tips that sound exciting and simple, but are either illegal, wildly risky, or just mathematically wrong. It's not always obvious. A lot of it comes from people who look confident and successful on camera, using real financial terms like leverage or credit utilization, so it feels legitimate. Leverage just means using borrowed money to make an investment bigger. Credit utilization means how much of your available credit you're actually using. Confusing? That's kind of the point of what we're covering. This matters because these videos aren't just harmless entertainment. Some of this advice can get you into real debt, damage your credit for years, or, in a few cases, get you arrested for fraud. And the algorithm doesn't reward accuracy. It rewards whatever keeps you watching. So the most confident, most dramatic claim usually wins the feed, even when it's the most wrong. Knowing how to spot it protects your actual money, not just your feelings about it. Here's why smart people still fall for this. Most of us were never taught how credit, debt, or investing actually work in school. So when someone explains it fast and with total confidence, it can feel like relief. Finally, someone's making this simple. But simple isn't the same as true. The creators making the wildest claims often benefit directly. More followers, more product sales, more clicks, whether or not the advice actually works for you. Let's look at 3 of the biggest ones going around right now and the real math behind each one. Myth number 1, the infinite money glitch. In 2023, a video went viral claiming there was a glitch at a major bank, where you could deposit a fake or bad check into an ATM and withdraw the cash before the check bounced. People lined up outside branches overnight to try it. Here's the real math. That's not a glitch, it's check fraud. Banks don't lose that money. They trace it back to your account, freeze it, and in a lot of cases, law enforcement gets involved. Some people walked away owing thousands of dollars in overdraft debt, with a fraud flag on their record that can make it hard to open a bank account for years. There's no version of borrowing money you don't own that's actually free. This one's a good example of the pattern behind almost all of these trends. Someone frames something illegal or reckless as a clever loophole, because loophole sounds smart and fraud sounds scary. The word matters more than you'd think. Myth number 2. Buy 10 properties with no money down. This one usually shows someone standing in front of a rented mansion, saying you can build a real estate empire using other people's money and zero savings. The strategy usually involves stacking multiple loans, a mortgage, then a home equity line of credit, then another loan against that, to buy property after property with barely any of your own cash in the deal. Here's the real math. Every one of those loans has a monthly payment, and none of them disappear if a tenant doesn't pay rent, or the property needs a new roof, or interest rates rise. Say someone buys a rental property for $400,000 using only a small deposit, with the rest borrowed across 2 or 3 stacked loans. If the rent covers the mortgage exactly, there is zero room for a vacancy, a repair, or a rate increase, all of which happen eventually. That's not leverage working for you. That's leverage with no safety margin, and it's the exact structure that caused a lot of real estate investors to lose properties during past downturns. Borrowing money to invest isn't automatically reckless. Plenty of homeowners use a mortgage responsibly. The problem is stacking loan on top of loan with nothing held back for when things don't go perfectly, because eventually, something never goes perfectly. Myth number 3. Skip saving anything boring and put everything into one hot stock or coin, because that's how people actually get rich. This one preys on impatience, and it makes slow, steady investing look embarrassing by comparison. Here's the real math. If you put your entire savings into a single asset, your outcome depends entirely on that one bet. It might go up, It might also drop sharply in a single day, and unlike a diversified fund that holds hundreds of companies, there's nothing spreading that risk out. A diversified index fund, meaning a fund that automatically spreads your money across a wide range of companies instead of just one, tends to smooth out the bumps over time, precisely because you're not depending on one company or one coin to carry your entire future. That doesn't mean it always goes up. Markets can and do drop, sometimes for long stretches, and past patterns are never a guarantee of what happens next. But going all in on one asset isn't a bold strategy. It's removing the one thing that actually protects most long-term investors, which is spreading the risk out instead of stacking it all in one place. Notice the pattern running through all three of these. An infinite money glitch, a no money down empire, an all-in bet. They all promise a shortcut past the boring, slow part of building money. And the boring part is actually the part that works. It's just harder to film, and it doesn't get you a comment section full of fire emojis. Confidence on camera is not the same thing as being right, and virality was never designed to reward accuracy. To be fair, not everything trending is wrong. Some creators do explain leverage, credit, and investing responsibly, and some risk can make sense for the right person, in the right circumstance, with money they can actually afford to lose. The issue isn't risk itself, it's risk dressed up as a guarantee, sold to someone who doesn't have the full picture yet. So here's what to actually do next time one of these videos shows up. Pause before you screenshot it. Ask what specifically would have to go right for this to work, and what happens if it doesn't. If a claim only works in a best-case scenario with zero mistakes, it's not a strategy, it's a bet. And if something's described as a glitch, a loophole, or a secret the banks don't want you to know, that's usually your sign to close the app and look it up somewhere slower. At the end of the day, this isn't really about spotting bad TikToks. It's about trusting that strategies that seem boring, steady, and slightly less exciting are usually the versions of money advice that's actually trying to help you, instead of trying to go viral off of you. If this helped you spot the next one before you fall for it, that's exactly what this channel is for. Subscribe for more of the real math behind the money trends everyone's talking about. Do you have another interesting topic you want me to cover? Another viral money trend you want us to unpack, or a finance concept you want me to walk through? Let me know in the comments. This is your finance sister. I'll see you in the next one.